Hi guys, I'm Greg Newman, Group Chief Executive of Onyx Capital Group. Today is a brand new show we're calling Flux News Show. It's all about the rebranding of Flux now. Everything's about Flux. It's our website, flux.live. It's our software platform, which has all our trading liquidity, our data, our services, and we have onyxmarkets.co.uk. Onyx Markets is all about getting everyone to trade. It's a market access service, and Onyx's mission is all about getting everyone involved in oil and energy. We think there's going to be a huge boom in volume and activity. It's an incredibly important market. So what we're trying to do is get everyone understanding this market and engaged. You've done crypto, you've done highly complex things. There's nothing overly complex about oil and energy once you get stuck in. So we've done our best with this show to move to a much more trader-focused, community-based kind of engagement podcast. We want to be asking for your feedback all the time. We want everything to be actionable for you personally, not just talking about some esoteric concept. This is about you guys. So please give it a chance. Let me know in the comments, let us know in DMs. We want to hear from you and we want to keep iterating until we really get this working for everyone who's interested in oil and energy. So please have a look. Hopefully see you soon and I hope you enjoy. Okay, hi, welcome to Flux News Podcast. I'm joined in the studio with Harry Campion, who's been working with me for 10, 11 years maybe, our last place, and the entirety of Onyx, being a trader, broker, everything you can think of, now helping run Onyx Markets, our retail brokerage arm and CFD arm. And we've got Martha, who's been on the podcast for a couple of years now, who's a research associate as well. Hi guys, thanks for doing this. And yeah, let's get straight into it. So the first thing we want to start with is what is the temperature in the market? So in other words, you know, the liquidity, the flow, the price action, what's the general feel? And the general feel we've decided is warm.
Warm.
Yeah. So Harry, when we say warm, what do we mean?
Well, I think at the start of the year, you could make the argument that it was hot.
Yeah.
When you had some fairly decent trending moves.
A lot of excitement, a lot of people thinking that flat price is going to come off because of Trump, that kind of stuff, right?
Yeah. And like Trump was tweeting every 10 seconds, changing the market.
Yeah.
High sulfur fuel had an enormous rally.
Yeah.
NAFTA had a good rally.
Yeah. A lot going on.
A lot going on.
So now I'd say, well, more talking about flat price in particular, it was just that we had the setup for quite a bit of a bull run. So we were testing kind of 69, 68 on Brent. Then kind of that's been the cycle for a while now. We got really short, as in the speculators, the CTAs, right, Martha? They got very short and we had a kind of bounce back.
Yeah, so we've seen last week both Crude, both WTI and Brent saw additions in long positions, which we haven't seen for a while.
Yeah.
But WTI has seen 3 weeks of overall open interest drop. Yeah. Whereas Brent, we've seen the opposite in 3 weeks of increases in the open interest, like overall in the contract.
Yeah, so that's picked up a bit of a bull move, you know, $3-4 in Brent. It's definitely trending higher. The front Brent spread's usually a good indicator of crude strength. They've rallied quite aggressively up to like mid 60s. Dated Brents are warming up. Yeah, refinery margins are good, so people are churning it out. The demand seems okay. Gasoline is picking up. Yep. All kind of trending north in gasoline and crude, which is kind of like your two indicators of like quite a healthy like Western oil market. Yep. I'd say so. That's kind of where we're at with warm. So trending north, and you could start to blow out. So I guess from there, it's what is the main driver? What's driving the herd, as we like to say? That's kind of sentiment and things like that. So there's probably a few things to talk about. What is driving the herd? I guess sanctions last week probably be a start.
Iran and like as of yesterday, like Venezuela as well, potentially. Yeah. Sanctions. So yeah, I guess that's in most markets is a driver. It feels like the ceasefire potential for Russia-Ukraine is driving the distillate market maybe a little bit more, and potentially gasoline as well. I don't know, is that been suppressing gasoline a little bit with the kind of threat of some more exports?
What's the thing when we talk about a driver? It's like what the market what the herd, let's say, wants to react to. So last year, the back end of last year, everything was about Gaza. Everything was Israel, Gaza, and there'd be a headline out, and then the market would move. The closer we got to a de-escalation with Iran and that situation, the more we sold off in flat price, and kind of vice versa. Now, Martha, right, we don't even get reactions to the Gaza kind of stuff.
So, I mean, in terms of Trump tweets, we've seen him have this very aggressive rhetoric against the Houthis in Yemen, and he's saying this is all, from Iran. He's saying explicitly he's going to punish Iran for whatever they do. They have struck US ships, and they have said that they're going to resume strikes in the Red Sea as, Gaza's not getting the aid that that it deserves. So this is impacting freight a little, but in terms
this
of
was massive last year, right?
It was huge. We saw blowouts in the naphtha east-west, and then the gas oil east-west had a huge sell-off, and it was really, really important, and the freight went sky high because it was such that that bottleneck is so hugely important, I think. And but since the news of the strikes resuming, there has been next to no reaction from the naphtha market. I mean, in the window after it was announced, there was some short covering, and people kind of blew that into oh, this is going to be a whole thing. But the next day, it was meaningless.
Yeah, so that whole thing, does it matter, right? That we've mentioned before. Okay, so a big headline like that, it can or cannot matter for the outright prices, whether people want to trade off it, and clearly not. But actually, we would say the second layer impact on the oil markets is usually the naphtha market, right? Because it's so important for the naphtha cargoes moving east. But you're saying even that didn't have an impact, right? Really?
No.
Yeah. So that's, from a trading standpoint, kind of unusual. We would have expected the East-West to rally. I think we're going to talk about this a little later on, but that's a classic example of, that's the market usually would have reacted by buying East-West, right? It's a trade we would have done sitting in the seat shit, we need to be, buying the East-West here because of this kind of stuff. But actually, there's a lot of sellers in the East-West. There's open interest getting very high in the Asia East-West. In other words, if trade houses and majors want to sell it, and there are enough of them selling, they're like, look, it might be bullish news, but we're going to sell this, right? And
we would be the ones who would buy it usually. So if we want to sell it, yeah.
So they've got something structural going on. And when they build up a big position like that, and they are building up a huge position, it looks like, in the East-West kind of as a collective, there's usually some kind of more structural, physical going along with that, right? They're not just blindly selling paper. They've got something structural.
Yeah, if there's fundamentals that would support it, you can't deny if there's...
Well, I'm saying that they've even moved cargoes themselves, right, to be loading, and they're not going to stop that. So if people want to speculatively buy, they're like, well, you're buying on the basis there's going to be not enough Asian naphtha loading in Asia.
We can keep the oil flowing.
We're the ones we can keep the oil flowing. Exactly right. So that's clearly not moving the herd. So I guess we need to turn to, it's been, I think we got the bullish impetus from the spec length re-entering. It probably got too low, like it tends to. But what's kind of exaggerate that momentum, I would say probably now we're talking about Trump's kind of switched from his focus being bearish oil, all the oil back online, to Venezuela and Iran, maximum pressure. There was only yesterday that he announced the 25% tariff on anyone who dealt with Venezuela, which is a pretty big deal for fuel oil markets.
And gave Chevron a 30-day notice to
stop.
Exit.
Okay.
When they would have had 6 months.
Yeah, it was
usually.
to the end of May, the original extension.
Right.
Yeah. So I said these are kind of structural things. It's a good headline, but then the Venezuela, the Chevron thing is quite structural in the sense that was a bit of relief of oil.
Yeah.
I think we need to talk quickly about, the Canadian tariffs in oil was such a big deal in the US, and probably people thought how come? When we talk about does it matter, you would usually put that in the category of it doesn't matter to global markets, but it massively mattered because of the way US refiners are. Do you want to just go over that a bit, Martha?
Yeah, of course. So the US refiners in the Rockies especially, the refineries are optimized to run on the heavier sour crude that they can get for cheap from Canada. We're not going to see people stop buying Canadian crude because that doesn't make sense, but it's more likely we're going to see a shift into these refineries perhaps running a blend of lighter, sweeter crude, which would be less efficient for the refineries, fairly significantly. And that's something I'm looking at the moment. But also it's just kind of a cost impact. So they're buying it for more expensive. They're going to have to sell it for more expensive. And I
sell
think
the products they're yielding more expensive, which is why gasoline in particular.
Yeah, I think it might be actually quite a significant difference across the country, especially prices at the pump. And I think
for traders out there, whether you're a retail professional, this is the thing about trading benchmarks. When you trade RBOB in particular, the biggest gasoline contract as a future, that's New York Harbor, right? So you can't just say, as you're about to reference there could actually be a very unchanged or unfazed pricing in California, but in New York, it's very impacted because of the relationship with what we're talking about. They get crude or they get refined products from the Colonial Pipeline down from the Gulf Coast, the Canadian, the way that all adds up, this is definitely going to impact them. And it's going to lead to, or it did lead to, higher US gasoline prices. And then if the US gasoline price didn't particularly perform, or you didn't want that trade, or you didn't want to reflect your trade in that way, what definitely performed was the US versus Europe differential. Now that usually
was so high.
That was like, I wouldn't say it was historical. It was probably historically high, but not all time high.
Compared to the same time last year, it was double. It was like
wow.
23. It was at the time the highest level it had been for I won't guess, maybe March.
Yeah, quite a lot basically, and that was a very good trade reflection if you've been on top of it. Actually, I think the majority of the market was short, and that's probably maybe more of the widowmaker stuff we'll talk about later. But just to keep the flow going, because we're talking about what the herd's looking at, right? The point we're trying to make is there's some imbalancing or rebalancing of US crude markets in particular.
Yeah,
they were trying to buy a bit more Venezuelan because of the OPEC cuts. They were getting relief from the Biden administration. Canadian was flowing nicely. Now Trump said effectively no Canadian, no Venezuelan. So you've got none of the crude or a lot less of the crude that the US likes to buy in the Gulf Coast. So it's basically causing a bit of a shock to the logistics. So what does that actually mean for the generic trader just trying to take a generic view? Probably not a lot, because it's not going to be like bullish outright prices necessarily. This is more differentials, right?
So it's a grade thing.
It's a grade thing. So that's probably going to be driving fuel oil markets, I would say. Venezuela in particular is the fuel market's very sensitive to to Venezuelan headlines. But I guess, so what is going to be moving it? I would say probably because of the sanctions on Iran and Venezuela, it's probably back to OPEC headlines, because we had the OPEC discussion around trying to claw back the overproduction, something like that, right, Martha?
Yeah, so they basically admitted that countries were overproducing. I think some members of our team especially have been kind of pointing this out, and there's been a definite shift in the market for people kind of being able to come out and say this, because I think it's kind of been a bit of a touchy subject, but they've kind of come out and said, yes, countries are overproducing, other countries are going to compensate for this.
Yeah.
And, everything's going to be fine. Don't worry about it.
Yeah.
Yeah.
Okay, so I think essentially what's driving the herd is probably OPEC now. Do we think that's fair? OPEC and sanctions, kind of the same thing. Middle Eastern crude.
Yeah, Middle Eastern crude. Because I guess when you've taken if people are pricing in that Iran and Venezuelan stuff is going to be taken offline, I guess, the next, that production is going to be made up from OPEC potentially.
So what if you're looking out for these news? We've got Flux News where we're putting headlines all over the place coming from the internet. You've got articles on Flux, flux.live, our Flux News website. So you're keeping out for, if OPEC says something, that's probably going to move the market in the outright prices quite a lot. So you need to be kind of on top of that. Gaza, not so much, we don't think. So not to ignore it, but really I think everyone's focusing on what OPEC are doing, particularly as April was when they're meant to be releasing more oil back online. If they're actually going to be now reducing in effect, plus the Venezuela going offline around, that's clearly where things are at. So expect a lot more bullish rhetoric on X, on LinkedIn, and certainly on X. I've seen quite a few people they're constantly talking a bullish game lately, and there's quite a few justifications for that, like stocks being low, the open interest being, or at least the short open interest being overdone, things like that. So I think there's quite a few people out there who want to see this market higher, who kind of believe in it being higher. So I think the momentum's with them. So now let's talk about the gold rush. So what do we mean by gold rush? This is the people who've made money, or people we think we've made money, looking at our data, looking at kind of what's going on in the market, what we've heard in the market. Picking those key contracts and kind of going through those trades basically. So I think the best one to start with, I think, as we've been talking about it, is just Brent futures, right? Ultimately, we had quite a bit of talk around 68, 69, like I was saying. We had new buyers entering on a speculative basis, like Martha was saying. So because it's been quite a steady rally the last week, right, Harry, that's usually indicative that it's a lower volatility enough trending rally that you'd expect people to make money out.
Yeah, exactly. It's been like a nice volatility trending rally, a week time frame, which, like you say, is kind of like a standard time frame for spec traders. And you've had like a $4 or $5 move up with no real signs that there's been kind of stop outs or profit taking aggressively yet. So yeah.
And if you're in a trade like that, right, you want to know that when you buy it, let's say in this scenario, it's kind of moving in line with your expectations, and a steady move upwards. You can be, you're living that. It's not mental momentum. So it's kind of, then you get reinforcing headlines.
What you want to see. It gives you confidence. Yeah.
But as in like the sanctions headlines then came out, and then you got even more confidence, and you kind of scale in or let it breathe. And it's all been very orderly.
You've had a lot of confirmation on the way up as well. Yeah.
So then I guess if there's a bit of a shock now, like some new headline, which undoubtedly there will be with the markets these days with Trump and all that, you might get a bit of panic. But I'd say that, the longs that bought around this time 7 to 10 days ago are doing pretty well. They're probably quite likely to have made money and make money out of this. Yeah?
100%.
Cool, nice one. And then I guess, Martha, we should touch on the technical setup for Brent futures.
Yes, I mean, just looking at the daily candles, I have a chart up here. And as you say, like there is some bullish confidence in the market. You can see that the lower shadow of the past week have been like pretty long. So that shows that players are happy to buy. There is, that strength in the buying, and they don't really want to be...
Could you explain that a bit more?
Yeah, of course.
When you say the shadow?
So this is looking at the past week or so. And as you can see, the candle, the lower shadow, which is kind of the stick under the body, fairly long in probably... a handful of the days, which shows that the prices are moving that low during the day, like that's the low of the day, but it closes higher. So there is really good buying at these levels, although it drops. That's not where the market wants to be. It wants to move higher. Just put that in layman terms a bit more. So you're talking about this, like this one on the left, is it the one you've drawn annotated there, is it? No, sorry, that's we're talking about Russia.
Oh, okay. And so you're on the right.
All of these candles here have that kind of lower bottom shadow.
Right.
Although these two have the fairly long upper shadow, so maybe there's not the great confidence, but it shows that there is that steady trend that you were talking about earlier.
Right.
And they're fairly good, thick, real bodies of the candle. So that's the difference between the open and the close.
Yeah.
Especially on these 2 days here.
So it's basically suggesting there's like pretty decent buying at floors, right? There's a pretty strong floor every time we sell off.
Yeah.
And then you're resetting it again and again and again, higher and higher.
And you've got higher highs and higher lows, which the technical guys always love to see on a trend.
Right, there you go. Okay, so that's very well technically set up.
Yeah.
And then that's to maintain. I guess we talk about that a bit later, but that looks like it's going to maintain.
So looking at the momentum indicator, which is quite a good way to look at how we see the trend continuing, this is the MACD, which is a type of momentum indicator, and we can see that the histogram is in the positives and kind of trending up gently. It's not as high as we saw, at the beginning of the year, but we can see it's a very good trend, and it's moving kind of nicely from the lows to the highs.
Yeah.
The moving averages are moving nicely.
No, fair play. By the way, this is all on Flux that Martha's showing. So again, this is all available to you free if you have an Onyx Markets trading account, or it's $400 a month if you just want it outright. So yeah, that's what she's doing there. Yeah, that's Brent futures. What other money makers do we think has been out there?
So the NAFTA cracks, I think people are making money on, right, Martha?
Yeah, I think definitely people are making money, and certain players lost a lot of money, I have heard. So we've seen the fundamentals of NAFTA in both regions being pretty poor, like the petchem margins are weak, and there hasn't really been much kind of fundamental reasoning for the strength that we've been seeing. But in the physical window, we've seen what essentially has been kind of a pricing play from a European major, and essentially they just couldn't hold the position anymore, and their strength has crumbled. We saw really strong selling build up as players were like, okay, there's no reason for this strength, and then those sellers have kind of broken through the physical pricing play, and we've seen this really strong sell off here. So
yes, I think there's quite a lot going on. What you just said there. I mean, ultimately for traders out there, we've been trending north in that for whatever the reasons may be. But ultimately, if we're just talking about the traders themselves, it looks like one or two basically majors were taking on the NAFTA market, and which is quite common actually in Q1. We see that as like a seasonal thing. The cracks tend to roll up. So that's the NAFTA versus Brent, right? The refinery yielding of NAFTA. So really key for gasoline blending, for petrochemical feedstock and making plastics and all the rest of it. So really key one. I would say, majors kind of taking that on, and on a physical basis, you would think if they're doing that, there's some physical justification. But I guess what you're saying, Martha, is it kind of was overdone, and the physical support maybe wasn't really up there, which is what we've seen evidence of when it started to price. The pricing window being where things actually get set, and the price reporting agencies have a tendering window, and you see all the physical playing out. So you're saying that basically gave way, and actually the majority of the rest of the market, let's say everyone who wasn't that couple of majors or whoever it was, basically like took it on and got short, and they've actually done pretty well because it looks like they accumulated most of their shorts.
Yeah, I mean, there was a
highs.
huge build up in trade house short positions in both regions actually, and we had seen.
But where were they building up their shorts? At what level? Kind of around the highs, or was
of past month. So
to be fair, they're probably losing money for a time as well.
Yeah, definitely.
Okay.
I think they peaked in, if memory serves, in Mokche flat price around 1.7 million barrels short with Onyx.
Yeah.
So like they had a substantial position, and I think they continued adding to the position as we kind of saw this, that we saw this resistance level here at about minus 240, especially at the beginning of March in the crack.
So again, we have this data. This is our Onyx's data about our trading. We're big liquidity providers in the market. And NATFA, we can range from 25 to even 40% of the market share. So usually our trading and the kind of opposite of what we've been doing is obviously indicative of what traders out there have been doing. So we're saying that actually the majority of the market's been selling on the way up, but this one particular buyer or two particular buyers have done very well in getting it up to where it got up to, but we've reached that resistance.
Yeah.
So it does look like you could say that if the majority of the market sold into it and it's coming off, I agree with you that is obviously making money right now.
Yeah.
But I'm just very cognizant that, with a contract like an OTC NATFA contract, there's a lot of selling, there's a lot of open interest, and they're kind of they're still holding this bag, right? Mm-hmm. It's not easy to then exit this market. So I would say, even though they're temporarily in the winning seat, it's not necessarily that bearish going forward, right?
Open interest is really, really high. We saw the contract break the previous highest level it ever was, like early in the month, which is pretty remarkable.
Yeah.
And just from looking at the candles, it's quite a classic pricing play thing where in the second half of the month, you sometimes get whoever's putting on the play, it can often completely fade in the second half of the month.
So first half of the month, there's a decent momentum, and then
kind of see momentum kind of peaks in the first half of the month.
Yeah. Well, you can see just from the price action, it's been resistant, right? I mean, we have volatility graphs as well, and the volatility I imagine would have spiked, and as it levels off, that's usually indicative of as you say, that
you get
resistance.
this kind of consolidation, and then people really start to put the foot on the gas, trying to take it on, and then you get this kind of collapse in the second half of the month.
Yeah. The only thing I would be wary about with the NATFA crack is like with everything in the oil market, it's all very linked. And I think if RBOB is going to be strong, and we think RBOB's performing quite well, the momentum's there, that then filters to the European gasoline, and then of course you've got the relationship with Europe and NATFA's quite strong.
Yeah.
So basically what I'm saying is gasoline could drag that up. And as long as there's, gasoline versus naphtha selling, which is quite common, and maybe some strength coming from propane as well, that tends to be, quite a lot of impact on the naphtha flow. So there might be direct sellers in naphtha, but they also have to fight effectively gasoline and propane flows, right?
Yeah. And it can change really quickly. All it takes, markets like LPG can move on a dime, and then all of a sudden naphtha just gets dragged up as a complete, byproduct of that move.
So
same with gasoline.
Quite call that a gold rush. I call that gold mark to market, maybe. But let's see how it plays out. I mean, that's certainly a very, very interesting one.
I mean, I think we'll probably be happier at these levels. There was very little real buying, and the fundamentals are not very strong. I know gasoline's kind of ticking up, but the naphtha component, we don't really see these levels being very attractive for loads of buying, and petchems are just terrible.
Okay, cool. That was more of a niche one. Anything else, Harry, on the making money?
Yeah, so we talked quite a lot about Middle Eastern crude off the back of the sanctions, and we've seen a pretty significant move down in Brent Dubai differentials down the whole curve.
Yeah.
And according to our data, we think the market's been pretty short Brent Dubai and has been riding the move down.
Yeah, I mean, it reacted with the headlines we were talking about, right?
Yeah. I mean, so Iran sanctions, Trump saying he wants to, reduce their exports to zero.
Yeah.
more recently the Venezuela sanctions. I think we did see a little bit of a bounce in Brent Dubai, but it's kind of come off again with what Trump's been saying.
Yeah.
So yeah, I think from what I'm hearing, I think you've had funds, trade houses,
all piling in.
Like all piling in short.
And that kind of proves our point about what the herd is looking at, right? Because again, nothing like excites the herd more than like where there's money being made. So if people have been short Brent Dubai or sell Brent Dubai because of more OPEC headlines, and as we say, Middle Eastern crude, and then it goes down, people are making money and then it reinforces, right? So that's one that it very quickly moved down. I mean, we've got the graph we can show. I mean, it was pretty damn aggressive. Yes, the thing about this contract is, the thing about this move was, basically you have to be super high conviction to really be on top of these moves. You get the headline and you sell into it. But if something's already super low, like it was about minus 30 cents, something like that, or somewhere around that. I mean, historically, that's actually already super low, but because it has been like -2 kind of in the past couple of years as OPEC have been doing their production cuts, you would see that, the headline that comes out like that, it's a bit of a shock to the market. You come in and sell, you got some decent room for that contract to go. So it did go down quite fast. But in an OTC market, I mean, there is more of a screen these days. And certainly on Flux, we would be there for digital numbers. You can come and hit our numbers. You can get into the trade, but you need to be quick and high conviction. It's not like a traditional future where there's just endless liquidity. You got to be quite quick on that, right? So but it looks like people kind of kept selling, even though they maybe did kind of miss that initial move, and they're still in the money because the market moves so much, right?
Yeah. And I guess you had that, you had a bit of a bounce in Brent Dubai from when OPEC made their first announcement about starting to
started unveiling their cuts in April.
April.
So you had like a nice level to sell into.
Yeah. So then, I think people started maybe buying it back, and then I guess that gave you some liquidity. But yeah, like you say, it's quite a popular contract for speculators. And when you have this telegraphed move, Iran sanctions, it feels like a fairly obvious one if you've got high conviction.
That's a good point, actually. If you're looking to trade Middle Eastern crude dynamics, rather than flat price, Brent Dubai is probably the best one.
Yeah, right? And if you've got a nice setup from some sanction announcements, it's it doesn't surprise me that it was a fairly the herd piled into it.
Yeah, and the thing is, the herd piling in and making money, that's what we're talking about, right? That's definitely a gold rush, because those are the scenarios where you really expect people to have been performing, and they need to now liquidate, like we talked about with but we can see that happening because, again, structurally, it's quite hard to turn around a huge, supply taken off the market.
I was going to say, it's it might be priced in, but that doesn't mean that it's going to
bounce back. And we're not saturated either way, we don't think. So that's definitely been pretty good trade.
Yeah, because I guess you've got the kind of physical that's going to support that, right? If Venezuela and Iran are offline,
it's generally backed by.
It's not just a overdone speculative squeeze on Dubai or anything.
Yeah, and I guess looking at the numbers, a classic trade, or a minimum size, I would say, that you would expect in the professional market or the industry market is 100 KB.
Yep.
So a 40, 50 cent move, conservatively, and some people probably made $1 on this. So that's anywhere between 50 and 100 grand for those guys. But realistically, the majority of the big guys are having,
multiple millions of barrels up.
5-10 million barrel positions, so making, multi-millions on that move. If you've been trading on Onyx markets and you're a smaller player, what we'd expect you, if you put say $1,000 in, that's roughly going to give you, if you're using a 30 cent stop, that's roughly
3 to 5 KB.
3 to 5 KB. Yeah. So again, 50% of that, you could have made 2.5 grand quite cleanly on that. So for all intents and purposes, that's a good layup, and that's a good example of how a global headline, a differential that you can now access, and relatively predictably you can make good money. So
250% return on your money.
Yeah, not bad.
Yeah.
Okay, cool. So now let's move to the losses, and we're calling this one the widow makers. And that's a popular saying in the industry, or actually all of trading. Pretty harsh term, but it's a good way of saying, we want not just to find the contracts that, of course, there's always winners and losers in every kind of trade, but the ones that really shock the market, right? I mean, when we say winners, we expect the herd basically making money. It's orderly, like we said about Brent, like we just said about Brent Dubai, even NAPFA. But a widow maker is probably some shock event happening or some shock price action happening against the herd position that came out of nowhere, right? Those are the ones that are really nasty. We all fall for these moves. This is not a who's better, who's worse. This is just part of trading, right? And At the same time, there's an opportunity for people who can maybe be contrarian and catch these. But like, what do we think are kind of the biggest widow makers lately?
Yeah, so I think the one that caught everyone was the move up in high sulfur fuel. So
that was last couple of
like January and February, and even into like the start of March. So you had like 380 cracks and 180 cracks, which are the Singapore contracts, posting positive numbers.
Yeah.
So I think the 380 crack got to like plus 150 a barrel or something. Which is, you know, like unheard of. I mean, anyone.
And when it was meant to be trending down, right? Like we were believing this market was going south, and suddenly, bang, it goes into positive territory.
Yeah,
huge moves.
Yeah, and for reference, like, you know, zero is not even like usually considered a level worth like even thinking about. It's in if those cracks are, I mean, when I was trading fuel like 10 years ago, even the cracks were in like single digits. You start to like let your fingers and start to go short.
Yeah.
But yeah, like, I mean, as a widowmaker, you can almost forgive people for just selling into it every time it posted like another digit higher, like -3, -2, -1 flat. Like, anyone would bite your hand off to be short at those levels, like almost like regardless of fundamentals. It's just like, you know, the fuel crack shouldn't like touch a positive unless you have some insane fundamental like
to reasoning. Yeah, I mean, just to finish that explanation of the fundamentals, right? So you've got shipping fuel, high sulfur fuel. People put it onto ships. They use scrubber technology, which gets rid of the sulfur. But generally speaking, that is the kind of proxy for crappy fuel, right? That's for ships. That's for kind of goes into more processing, sometimes for bitumen or sometimes just refineries to run it. Power generation. So it's like pretty like cheap muck. The whole point of it is meant to be cheap, right? It's a waste product. So when it gets very strong relative to crude, that means that people start selling all these things, all this like kind of byproducts as into the pool, right? Into the kind of waste pool, because it's like actually very economical to do so. So, they've got basically refiners have these options, like at each time that they basically send crude through their CDUs, their crude distillation units and their processing units, they get like products out of it that they can either sell or refine more. And at each stage, like, you know, that's quite an important consideration for them. So when the fuel versus Brent goes high, that's basically saying like all your waste is basically free now. So they're just going to produce as much as they can.
Like the margins to reprocess any of that must have been like terrible.
And meanwhile, you know, we've got gasoline doing pretty well. So I mean, anyone who can like really like coke like high crack super like dense stuff and mucky stuff is going to be doing pretty well. But I guess the point is that it's not usual. So you would be forgiven for not expecting it. So I think the setup was, I think we had actually quite a weak Fed pricing from memory. And then going into March, people were like, well, it's going to happen again. And there's no reason, there's nothing out there fundamentally. There's no headlines. This was before the Venezuelan headline, this is before the Middle Eastern stuff, which does support what we're talking about, like the fuel market. But that was just a shock. So how do these things happen? Well, welcome to the OTC oil market, right?
And especially fuel oil. Like high sulfur fuel was one of the sort of first like established markets where there was like
financial
like high volume like derivative markets. And like, you know, big players doing pretty high conviction pricing plays. So it's not like a new thing. And you'd be forgiven for trying to find a fundamental reason why something was happening, but like you've seen it many times in fuel where just
out of nowhere someone will basically, you know, how do you get the price so strong? Well, this is the danger, which I think is very different to foreign exchange equities. You know, we have this pricing month concept, right? So the contracts, you can hold them in kind of any month down the future, but when it gets to the pricing month, so if you buy a March contract and you get into March, that then starts to settle to an index that uses real physical prices to the particular region, right? So everyone's short the 380 you were saying, the Singapore. So what does someone who wants to take on all those shorts do if they have physical? Well, if they know something or know of unexpected demand, or they just want to buy all the fuel oil, if they buy it all and don't basically sell it into the open market, then the price is just going to get super high. That's the general concept. That's why we call it like a bull play, a pricing play. And, you know, it could be a shock event, or it could just be like motivation from these guys who are long. And especially when you catch a market so short, I mean, let's be honest, they would have known the market's pretty short and been like, this is set up for a herd market to be completely screwed here. They're being complacent. They're not realizing XYZ, whatever XYZ was. So they come in with a big mandate to buy oil and they catch everyone unawares. And I think it was like, you know, So what do we usually expect? Like minus, even if it was like -$4, -$3 on the crack, so the price minus crude, you expect like a decent move, like 50 cents, maybe $1 per barrel. This move up $5, right?
Yeah.
Like one way, like it would barely breathe for a second. So that in that scenario, that's clearly the market being caught unawares. But then it's almost like a lot of people just freeze, don't they? Because they're like, what the hell is going on? And you're immediately going into that 5 stages of loss, like denial, what's going on? And you almost don't want to believe it, right? And you're just seeing this price roof.
Yeah.
Most people don't react, but the people who do react are of course making it even worse because they're running for the exit door, right? So they're just lifting any offer.
I was going to say, at some point you just start to assume that this is the new normal.
Well, or they could just go on forever.
Yeah, just go on forever. Like
that $5 move is, they love that, right? The people who do catch people unawares, that's what they want to see. They want to see people scrambling for the exit
like
door.
when you hit the max pain point.
Well, they've triggered it. It's like the dominoes, right? They've gone buy, right? Then they just hold off because the dominoes fall and
yeah.
You know what I mean?
Yeah.
So that's an example of like very, very, very difficult to trade. If you see it just suddenly moving, I mean, I don't even know, the Flux chart must have been mental. It's very difficult to participate in that trade, right? I mean, you're going to have to come in and lift something very quickly, and you're going to need to know why or have some conviction behind that, which is quite hard in that scenario.
Yeah, because it's always like when you're trading, you're like, what would I forgive myself for losing money on?
Yeah.
And if it was like buying 380 cracks at -1, you'd probably be like, yeah, but if this just dumps now, I'm going to look
it could go to -10.
like a
That's the historical norms. Yeah.
Like, so in that sense, it was probably still very hard for people to accept that it was happening. That stage of like loss, the kind of acceptance was probably really hard.
Really hard. And your risk manager comes over and you say, it's never been this high, so what do you want me to do? Or it hasn't been for a long time.
Yeah.
Let's just ride it out. But then you've got all these, the problem with that is that you're kind of removing yourself now from what, the oil story, the fundamental story is going, have the sellers got out yet? Because until they have, the price can keep going higher.
And when it becomes very prompt, a lot of the kind of fundamental outlets start to disappear.
Yeah.
Because your time frame is getting shorter, as in the guys who are long only have to ride this out for another 20 days.
Yeah.
And it's not like a refiner cannot just suddenly start, for them to ramp up fuel oil to them to suddenly produce a lot more fuel oil when a prompt contract like goes high. It's like logistically it just doesn't work like that.
Yeah.
You can't put fuel on a ship in Europe and then just put the afterburners on and get it to Singapore in 2 days. You're constrained, which is why the kind of pricing stuff can get decoupled. So yeah.
I think the only way you could really expect it to be on top of this is if you were trading in, let's say, small size and taking little punts based on the open interest. Like people were getting overexcited, right? They were overly short, and that did come in the data. And if you were just taking the chance that when people are too into something, take the other side, that's not a bad trade in and of itself. So, and if you'd seen that happening, geez, this is crazy, but at least, that's the only thing I can think of that would keep you or put you in the game here with that move.
Yeah. Which is like as valid a reason as like the fundamentals sometimes if it's.
But then also when we get such a big rally, and again, you can talk back to your experience trading fuel, you get this monster rally. What's also hard about this is that when you get a big localized rally like that, if something huge happens, like something blows up, every contract, March, April, May, June, like everything will rally. When it's clearly about this 1 month, you get that rallying, nothing else rallies.
Yeah.
And it's a pain because now you can't even sell the next month and buy the next month and be like, oh, I'm protected. If everything's, because it's a localized thing.
Yeah.
So you're actually going to lose money again if you try and buy the next month to hedge yourself.
Yeah.
So the only thing that can kind of be useful is if things get dragged up, but it doesn't actually, as you said, it's this play we're talking about isn't going to last.
Yeah.
So you can kind of sell things that are being dragged up because of this thing in the prompt.
Yeah.
That's quite a good trade, but I don't even think you've been given that opportunity this time with fuel.
Because here, like the March-April 380 spread was like $30 at one point.
Yeah.
So it was just, there was only one thing people.
And what's that normally? Even in a strong market, that's like $3-4 max.
Like $5 used to be like a high in backwardation.
Yeah. So you got 5 times the normal strong levels. Yeah, that's very difficult. That's very tough. So that is very much a widow maker. I mean, that's the very definition of a widow maker. Yeah, okay.
And I think the other reporting agencies were kind of trying to fit a story to it, which is why it's so like good for us to be able to see the flows of people say, oh, why is it rallying? Like, oh, because people are buying it. Like at the end of the day, we saw people saying it was because of really, really strong air conditioning demand. And we were like, okay, but the temperatures aren't that high, so that doesn't make any sense. And people were scrambling for a reason, but to be like, oh, but it's going to end soon. And like, well, you can't say it's going to end soon if you like you're making up this reason it's happening.
Yeah, I think that's really, really perfect thing to say. I mean, for people out there getting into this market, trading this market, you have to start with positioning first. You have to start with the trading technical reasons first. Then you can apply a story. But if you've got a story about the physical, remember, you're hearing that third hand. As you said, people are making up something after the fact. If someone knows they're about to buy fuel oil, physical fuel oil, because of whatever reason, the last person they're going to tell is you, right? You're going to hear that once the prices move. So there's no point attaching a story because...
But it happens every time, doesn't it?
It does. It's just slightly frustrating to see, like as if you can predict these stories.
I remember in 2015 when there was the kind of bull play on fuel oil as well, on the 380 spread, when like every spread was in contango. $2 contango, and then you had June, July, which was like $8 backwardation. And then it started pricing, and then there was all these like insane stories about like these new like contracts that were being made in like China, and this like bitumen demand was like, there was like, you know, Chinese bitumen premiums were like $500 a ton to like 380 or something, and like every day there was just like a new story. And it turned out it was just a trade house. Basically, just like
bought everything.
The management basically just went like, "What are you going to do to make like $250 million?" And they're like, "Well, we could just pile in on the spread, basically." Like that, and that was it. It's quite hard. It's hard.
It is hard, but again, the proof of that is like, okay, if that's such a big bull story, why didn't it happen the next month as well? Then, like, what is such a bull story, then such a bear story the next month? It just doesn't work.
Yeah, exactly. That, right?
So it's just something you need to be prepared for. I mean, it doesn't happen so much in the outright Brent futures. Certainly not the other outright futures. But when you get to the differentials, like we're talking about like the tariff causing the RBOB versus EBOB, or the US New York Harbor versus the Europe, that's a very key gasoline contract that blew out. So if you want to trade these things, you got to look for these differentials. They're very based on logistics and freight and supply and demand and all the rest of it. But every so often you get these shocks. The only way to stop yourself being on the wrong side of these shocks is to be aware of the open interest, right? Open interest, how many people are in this trade? If you're selling something that's been trickling down and the open interest is sky high, and we're talking like 100% more than the 5-year average, something's up, right? So at the very least, don't do something. But if you want to do something, it's hard to know which way it's going to go, right? You need maybe Onyx's data to say, well, from our trading, we see the market is long or short. That's one thing you can do. But generally speaking, I think it's more of like a just be wary, you know? The best trades, if you want an orderly rally or an orderly sell-off, is seeing the open interest being relatively balanced. Because there's more and more, what that's saying is this contract can hold more risk capacity. More sellers can come in, more buyers can come in, but it's trending down. So you expect the sellers to orderly come in. And that's what's happening right now with Brent, right? So we had Brent at the very bottom of, and again, we can show this chart, how the CTAs, like all the algorithms on the spec side were max short. And so generally when there's a bit of bullish impetus, you've got a lot of capacity for this market to be buying. And then it's quite a long time before you expect that to dissipate, because you've got quite a long way to go. So you want to be buying kind of on the way up of that buying. It's not just about price action momentum. It's about positioning momentum, I guess is what we're saying. So we're going to repeat this like 1,000 times, but it's oil markets are just so like that first, and then you can apply fundamental reasoning or have a long-term view, but don't think of it the other way around, because you're just going to get screwed. Because what they would have gone around to you and been like, mate, fuel's a bit cheap, fuel's quite expensive, right? You should sell it.
Exactly.
That's what people will sell to you, because they're like,
100%.
You blindly believe the fundamentals.
You know? and like you're never going to, like, you're very rarely going to be in that position where the fundamentals come to you first at like any kind of relevant point where you can actually trade it. Like by the time you've heard about it, you have to assume it's priced in. Whereas like the positioning is a lot more of a valuable thing, especially when you have a move like this. It's just
it's almost like the opposite, isn't it? It's like when you've got a contrarian view based on positioning or even technicals and something being priced in, you can kind of say, I want to be taking a chance or looking to take a chance on this reversal, and I'll set it up in a very risk managed way, whatever else. But you're almost saying you can kind of say, are there any things on the horizon that I can see that would lend to a bullish story? Like if you've been buying on the dips in Brent, you would have done quite well because of the position changing. But then as we were talking about, then some headlines came in that gave it a bullish momentum. So, you know, if Gaza had come out then, maybe people would have actually been like, see, it's bullish, because they want a reason to justify their buying and the price action. And then it becomes self-fulfilling. So rather than think like you need a headline to be cause price action, you need the the positioning setup and the technical setup, and then it's how the headlines come in. You see what I mean?
Yeah.
Okay, so winners and losers we've covered. Now let's kind of like change the tempo a little bit and do more of a deep dive. We're getting quite technical. I think there's some explainers we need. So we're going to go to Martha, who's going to lead the deep dive. And this is us going into Onyx's data, what we've seen, entry prices, things like that, and get a bit more like education on what we think's going on to kind of help out where we can. So Martha, are you going to talk about the naphtha crack again that we talked about earlier?
Yeah, sorry, we're back in naphtha. Right. But this is looking at the April contract of the MOPJ crack, so the Asian naphtha differential against crude. So the first chart here, which is what we've just been speaking about, is the open interest. So this red section marks anything higher than the highest level we've ever seen in an April contract before. So even in February, we were higher than that. There's been such high interest in this contract. This has been a really, really, really active market. Naphtha, as a general rule, we have seen fairly herdy movements. I think we've seen people quite burnt as well, like not really the same as gasoline, but I think people have been fairly tentative, and we've seen kind of big swings as pricing plays in certain trade houses who know where the Russian barrels are, what's happening with them. The market kind of follows what they're doing because they basically control the market.
Well, it's quite aptly called the danger zone, right? And I guess for traders out there, open interest is readily available information. There's Onyx's data, which we do charge for. I'm sorry, it's very good data, but ultimately you can still get a lot of what we're saying just from the open interest data, which is free. And we're saying look, the risk appetite is significantly above the danger zone. Like the danger zone being anything that's historically the highest it's ever been is flagging. Someone's put a lot of people put a lot of risk one way there, or even both ways. And to be 260% above the 5-year max open interest, I don't think I've ever seen a contract be that high. But just to explain that, I would say it's the absolute levels around 7 million contracts. Now, yes, that is a lot, don't get me wrong. But actually, the reason why I would say it's so high is because people who trade cracks, right, in every region, they pick the most liquid crack. So you've got naphtha crack, fuel crack, gasoline crack, blah, blah, blah. So with the naphtha crack, the crack that people mostly trade is the European crack, right? And they rarely go directly into the MOPJ crack to trade. Yep. So I would argue, we could probably prove it, the European crack is going to have a lot higher ceiling, or higher kind of levels generally. So it looks like unusually.
Yeah, a lot higher. We're looking at close to 25 million.
There you go. So it's basically like almost a quarter, or at least a third of the open interest of what it's normally. So it's basically what that's really saying is there's an unusual amount of interest in the MOPJ in particular, crack in particular. So it's probably going to be more indicative of the East-West, I would say. So the East-West kind of open interest probably is also quite high. But either way, I think what we're getting at here is unless the European...
Yeah, it's higher than the MOPJ crack.
Okay. Do you want to show that on the graph?
It's it. Yeah. So it's about 1855 million barrels right now.
So it's also in the danger zone, not as much, but it's clearly an Eastern naphtha focused thing. So something basically is going on in the East. A lot of people are interested in it.
Something... Oh, sorry.
Yeah, no, go on.
Something interesting to keep an eye on when you're looking at open interest is when it starts to decrease. You can see here the open interest in the East-West has been falling from the 14th. So that shows players closing positions.
Could you just show the European naphtha open interest as well?
Yes.
Yeah. So this is showing that, it's still, the 5-year average is still lower than where we are right now, but it's not yet at the all-time high. So this is kind of a crack story. I think there's a lot of interest in the naphtha cracks, but I think it's more of an Eastern story. So why are the East so bearish, and who in the East is so bearish? Is it the trade houses? Is that what you're going to say?
It is, yes.
Yeah, okay.
So we mentioned earlier the physical window being kind of propped up by this major, which isn't reflected in the paper flows that we have. But we can see this huge build up in short positions from... you can even look from 6 months ago. You can just to show how strongly short the market is.
Yeah.
So you can see here trade houses at their on the 24th of March were almost 2 million barrels short with Onyx in the MOPJ crack in April, and they were adding to that. They were adding to their short positions all throughout the month essentially, and just kind of absolutely the bulk of the open interest has been these trade houses being short. So I think these, if they entered at, should we work it out? Or we can look at the entry exit prices. So so these are looking at, so this is looking at the average long and short entry prices, rolling averages for 90 days and 7 days. And you can see that, I mean, they've been out of the money for all of the month.
So switched very recently. So this move down in the cracks has flipped the longs been in the money to the shorts being in the money. And we did mention that before, but it's very, very recently, right? So you would think that the momentum's now with them. But this is what I was trying to say. So that, people are going to start selling, they're going to be comfortable seeing this low, there's going to be momentum, but they've already sold everything they can sell. So in order for there to be enough selling flow to drive this down and combat gasoline, combat propane flows that are linked, you're going to need really the buyers to stop out, of which we don't think there's many buyers. It was basically one or two huge buyers, right?
Yeah, although we're still seeing positions being added, we're still seeing short positions being added, but open interest is essentially flat, which could point to long positions taking profit.
Yeah,
because they're like cancelling each other out essentially.
Yeah,
but
you do kind of
that's
see
just kind of a theory.
Direct dealings in the market. Like if we know about this just from our data, this is not a huge market right now in the sense of the players. They will know who the huge buyer out is there, and or one or two of them. They will contact each other when they feel, they can't go any longer, right? And they'll make a direct deal. Maybe it's a bilateral deal that doesn't hit the exchange. We've seen that plenty of times, right? And so all of a sudden you'll just see the prices move because basically you weren't in the know that the long is basically out their risk now. Do you see what I mean?
Yeah. Just another thing to keep an eye on generally when trading is volatility. So looking at the 7-day volatility here, as we looked at the graph earlier of price action, we saw that it kind of top out, and we see that in the volatility, which kind of bottomed out, which shows prices consolidating. There's not so much intraday volatility, and then a huge increase in volatility as prices are kind of gapping down, and there's more day-on-day changes. So
yeah, so I think generally the high open interest on these MOPJ cracks is fairly indicative that the contracts trend into being a bit more of a mainstream contract. So, and the Asian market just becoming more of a sort of the central market almost.
Well, we think it's going to keep going that way, right? I mean, the Chinese exchange has started to list more and more oil contracts, and it's enormous. Apparently majority is a retail market. Their fuel oil open interest is as high as the entire rest of the world, ICE and CMEs. It's crazy.
That's
how much
amazing.
I think they're the Chinese exchange is the polypropylene daily volume is 2 million tons or something.
And that's not even traded really in the
it's
the West.
It trades once a week or something in the US market.
That's what I'm saying about retail, right? People say, oh, the retail story, whatever. Look at China, right? Their retail market is bigger than the entire rest of the OTC market.
And in LPG, that morning market is all of a sudden is now purely driven by the Chinese exchange, basically.
Well, that's a good point. So if you're trading right now, you would say, look, I'm going to wait until the European liquidity comes in NAFTA, because that's where I think people are trading the most. And if I want to get liquidity, I need to trade that contract. But what you're saying there, which I think is very apt, is it's moving more east, because in the Eastern time zone, you can actually get Eastern contracts on because there are people who are there to trade it. Why? Probably because the Chinese market is way more active than it ever used to be on the retail side and the oil side, and they don't care about start dates. They'll start when they want to start.
Yeah, exactly.
So that's 3 a.m. for us here. That's kind of 7, 8, 9 a.m. in Singapore. No, sorry, even later, isn't it? 10, 11 Singapore. So it's moving that way. The liquidity time zone is moving that way. That's going to be a big shift for the oil market, I think.
And the uptick in open interest in cracks, you see the same on 380. Again, when I was trading fuel, 380 cracks rarely traded. And if they did, it was a weird thing that a refiner was doing. And it was
to get a specific hedge on.
To get a specific hedge. Because if people would just trade flat price, I guess the speculative Asian market was fairly infantile compared to the Europeans who had kind of matured to trading spreads and cracks. And Asia still had that connotation of just having that gambler's mentality where it's just flat price. And I guess it was the same on MOPJ.
Yeah.
So now you've got this 300% increase in open interest on cracks. It's kind of indicative of that. They are maturing and growing and maturing as speculative traders and starting to pick these contracts.
Yes.
Which are a bit more indicative of the underlying market rather than just hunting basically.
Yeah. Well, it's such a good point that I think you need to bring into this deep dive, right? Because ultimately, if you do the maths, at 7 million barrels, it's huge relative to what it's been, but actually relative to the overall NAT for crack open interest, it's adding to what the 25 million, is the 25 million the ceiling on the European crack?
That was what it was.
As in that's the actual level as it is right now.
I'll check before I say that.
Well, either way, if it is, that's 32 million barrel open interest in cracks in general. So basically what we're saying is pull them together and then does it reach high levels? I think if you say, what's the 5-year ceiling for European?
5-year max for Euro is 28.4 and we're currently around 23.3.
Yeah, so to be fair, if you add the MOPJ then, you are getting to above all-time highs on the open interest of cracks. I think you could say that. So it's definitely
That's a really good point.
Yeah, it's definitely over-invested in. It's definitely a flag. If I was short right now, I would not be blasé, is basically what we're saying is. But I think what you'd look at right now, if you didn't believe that the buying was going to come from NAPFA localized buying, because you think the buyers are gone basically, you're not out of the woods. You've got propane, and propane is linked by what we call the FEI MOPJ, basically propane versus naphtha, and that's quite highly traded because people switch between the two to crack chemicals. So if that flow comes in on the sell side, that differential sell propane buy naphtha, that will support naphtha. And on the same basis, gasoline versus naphtha, if a lot of people sell that, then you're going to get buying flow from naphtha as well. And the gasoline versus naphtha is rallying. Go on.
Yeah, so we had seen those two exact things in the time where it was rallying. We were seeing lots of gas nap selling in Europe especially, but the FEI MOPJ was being sold in Asia.
So
and there was
the
loads of
reverse
CP, so Middle Eastern propane, CP, which is the Saudi benchmark. There was loads of buying from CP players in naphtha as well. But also I forgot to mention this earlier, but looking at the physical kind of between the East and the West, we've seen a lot heavier flow of naphtha coming out of kind of the AG region. And in all honesty, we don't really know where that's coming from, whether that was kind of like a deliberate bottleneck of a pricing play kind of being loosened or like some storage being put out, but we don't know why that's happening exactly, but we do know that will probably keep pressuring prices for a while.
I guess just one last thing on that then. So we're saying that these differentials can impact, but it does look like actually if we looked at the charts, gasoline versus naphtha and maybe FEI MOPJ as well, but definitely gasoline versus naphtha has been on its way up. So that is kind of like, it's almost like it's the unwinding of all these three flows together. So if naphtha selling has died down because they don't have enough selling volume behind it because they're already sold, but there's not that much buying, then actually it could be the gas nap buying that actually kind of drives naphtha going forward. So you just have to look at a number of things, I guess is what we're saying. Hence we did the deep dive. So thank you for that.
So the naphtha deep dive that we've been talking about is available fully interactive, showing off the best of our data, as well as a collection of 4 or 5 other deep dives from previous weeks. And they're very interesting and a good in-depth kind of case study to learn from and to take into the future, available on Flux.live where the research is.
Great. So now, okay, there's probably enough of what's happened in the past. Let's get moving to what's going forward. This is our segment that we're going to call the Crystal Ball. So we're going to start with Onyx Beta, right? And we will work on this becoming more of like a formal index. But just to begin with, we're going to select a few contracts that we think are basically in line with what the generic oil market is doing. Because if you say outright prices are moving, that's only one component, right? There's time spreads, there's differentials. So we've picked the Brent flat price. We've got the M1 versus M2. So basically the front time spread of Brent futures. We've got the EBOB crack, which is the European gasoline crack. And we've got the Singapore low sulfur fuel crack, which is more direct shipping fuel. We were talking about high sulfur fuel before. This is low sulfur fuel oil that's used directly in ships in Asia. So Harry, or I guess Harry and Martha, let's start with Brent. Keep it really simple, right? Basically, are we bullish or bearish in the next week for Brent flat price?
I think what we've been talking about this session seems like we're all pretty bullish at the moment. Martha brought up the fundamentals earlier.
So just looking at the moving averages, the purple line on the graph is the 10-day moving average. That's passed from under to over. The 20-day moving average, which shows that the bullish momentum kind of overtook a day of kind of fairly cautious, to be fair, bearish momentum. And then even a day where we saw fairly headline news from Russia and Ukraine of them both promising to stop striking each other's energy facilities on the 18th. We saw those losses gained back the next day, which I think shows that this wasn't a significant, this isn't really what the market is looking for changes. And I think the sanctions news, it's very kind of understandable by everyone. It's very threatening. It's using quite severe language. And I think we're going to see, in my opinion, the gentle rally continue.
Great, perfect. And then the M1 versus M2 Brent spread. So that's the, I guess the prompt month right now is May versus June. So May versus June, just context. Usually, actually, we expect May, June to be pretty strong anyway, right? The May, June, July fly. I was a North Sea trader, dated Brent trader, which is very related to these Brent time spreads. Seasonally, you do tend to get the Chinese in particular coming out of turnaround. They're after North Sea barrels to import. So we tend to like this fly in general. And actually, you kind of want to be short April, May, June fly. So now we're in May. That's one thing I would say. So given that seasonal backdrop, as well as kind of the bullish rhetoric we've been seeing, I think straight away I would say that's also bullish, right? And they do tend to be correlated, but not always.
And at the moment, the dated Brent market is backing that strength up, right?
Yeah, big time. It's been floating around, in line with flat price, threatening to sell off. But buying dips has been quite a strong thing in dated Brent. And now I think at the beginning of this week, so yesterday we had basically Exxon come out and buy in the tendering windows kind of publicly. There's decent buying support just in general for physical players of North Sea barrels. And in return, the pricing's doing really well. So the dated Brent is it's the benchmark that is the very spot contracts, and it's basically nearer term than the Brent futures. Hence, we're talking about May, but we're talking about March and April barrels, or April barrels now for the spot contract. So it's linked, but not exactly the same thing. So the momentum is strong there. So I think if you're just talking fundamentally and seasonally and momentum based, it's bullish. I'm trying to think of why you wouldn't be so bullish. The only thing I can think of is if there's so much buying from basic refiners, if the fuel oil market is strong and people have hedged enough of their outlets there when it was strong, you're looking at basically the refinery margins potentially collapsing. But we're way off that, right? And the refiners can still come in and sell those refinery margins forward. That's what hedging is, right?
Yep.
And if it's very profitable, they can just sell as much as they like and buy crude in the open market and make money, right? So I think it's very hard to be bearish right now, I think.
Okay.
I've kind of monopolized that one. But Then to the EBOB crack then, I mean, again, we were talking about kind of a general bullish performance in Q3, but maybe you could talk a bit more about this on the gasoline side.
Yeah. I mean, I suppose there was a pretty significant sell-off in EBOB, especially once Trump got elected. There was a lot of uncertainty, and probably still is, on what the effects of tariffs are going to be on European gasoline. You obviously had the US to Europe differential
get very strong,
even as RBOB cracks were weakening at some points.
Tell me, say that's why that's important though. As in, if that differential is really high, but then Europe actually can't send any oil over because they're worried about being tariffed.
Yeah,
that stops being a bullish thing, because basically the arbitrage is incentivizing barrels to move over, so they're going to make money. So it makes Europe stronger. That's usually what we'd say.
Yeah.
But because they're so worried about being tariffed, it's actually bearish because they're going to keep the oil there. Right?
Yeah, they're going to keep the oil there. So you had that differential, which is almost allowed to rally, even as the traditional correlation of, you have a weaker RBOB versus Brent crack, and it can kind of pull the ARB lower to keep the
arbitrage balance.
The arbitrage balance. But yeah, I mean, last week there was plenty of chat about, the ARB being open, the European barrels being the arbable barrels east and west actually. But yeah, just,
no one wants to do it. They don't want to set a cargo on for a couple of weeks.
Yeah.
Only for mid-journey, Trump to say tariffs.
Yeah.
That's a huge loss, right? I mean, 25% on a notional barrel of I guess it's around $80 per barrel on a gasoline basis.
Yeah, about that. Yeah.
So it's $20 per barrel hit. Right?
Yeah.
That's massive. You can't take that risk.
Yeah. So you saw it kind of sell off to a point where you did start to get that summer buying. I mean, where are we now? We're just kind of coming into April is the front month. So the start of the summer in like the gasoline contract. So yeah, people start to turn their attention to like Q3 traditionally. People start buying into the Q3 contracts, I think.
Yeah, why is that traditionally? I mean, it's so standard, but I guess to go over it again, it's just generally speaking, summer gasoline demand strong in the US.
Yeah, and it's like I suppose for the traders, it's like a comfortable, self-fulfilling like story, which has been a pretty reliable moneymaker, like historically. So yeah, you know, long summer gasoline cracks and time spreads, you know, traditionally pays off more often than not. But I think
it's particularly after you've had a big dip, if you can enter
when you've had a big dip, and I think people look for that like kind of end of winter like dip to start allocating that VAR to it. You know, they don't want to like do it too far in advance, because then they have to ride out a lot more volatility. And especially in the winter when things can just get like dragged down. So now, you know, you're coming out of winter, I guess there is a lot more confidence to start allocating that VAR to those.
And we have seen that, right? Position build up in Q3 and the momentum's there. The only thing is, and I think we will agree then, so the next week on a beta basis, we think longy will crack as well. So long all three of those things. It's just this tariff thing is...
I would say, like, for me anyway, it's the mainly like the kind of bullish is just the positioning, like what you would expect people to be positioning.
Yes.
Like, I don't think there's like an overwhelming bull story in gasoline at the moment, but I think you do have that positioning.
So take advantage of the positioning momentum.
It's such a powerful thing, positioning in gasoline, especially in the summer. And yeah, I don't feel like it's oversaturated yet.
Can we whack up just quickly the gasoline COT? Yeah. So looking at the open interest, we've got July, so that's in Q3, right? So the first summer month, really. Yeah, we are above the 5-year open interest for this time. So it is getting ahead of itself, which you'd expect, right? Because we've had the price dip, like you say, Harry. So that basically shows it. But also it shows that we're quite a long way away from being oversaturated, which would be kind of the orange line and the danger zone. So I would say that's pretty bullish as well, right? I mean, you've got some more capacity to go in. So that makes sense. So we'll stay bullish on that one. And I guess the last one being Asia low sulfur fuel.
VLSFO crack,
Any insight on that one?
It's a bit more difficult, that one, because it's kind of, I mean, that whole crack curve has kind of flattened out a lot, and actually you've got like negative crack rolls on the front. And such high sulfur fuel, you'd think that something would be supportive for VLSFO. So I don't know fully like the fundamental picture, but like things must be keeping it suppressed. And
to us, it's very similar. You have this Q3 air conditioning demand tends to be the seasonal story, which is I think it hurt quite a lot of people last year. I think again that's one that I wouldn't be if I'm going to be bullish everything in Q3 anyway, and you got this momentum. I mean, I actually would probably be bearish as a portfolio. Do you know what I mean? Bearish the low sulfur. I think you've got basically a market that's been overbought for quite a long time on the fuel side. It's low sulfur fuel, so it's actually more linked to crude light sweet crude markets. You're going to need like a big fundamental story for that to continue to perform whilst you're still relatively high in that kind of shipping fuel complex. So personally, I would think that's the one that would be bearish, especially if we were bullish the other three kind of spaces. Fair?
I would agree. Yeah,
cool.
Just one thing to point out with the technicals of that contract in particular, if you look at the graph for the M1, with the rolling M1 for the same 0.5 crack, you can see that there is a descending triangle forming, and with the Bollinger Bands, which are indicative of volatility, they're kind of pinching as well. So we could be looking at a breakout soon.
Breakout either way.
There's no, well, that would be which you'd pick.
Yeah, I mean, I guess that's what I'm saying. I think another thing about this rally is if you're getting gasoline cracks rallying, you are supporting the margin. And then if there's a lot of crude buying and a lot of run rates being high, fuel being high, then something has to give, right? Refineries can't just make money forever unless there is a huge supply glut, which we don't think there is.
Do we see this? Oh, sorry. I just have like a question. Do we see the 0.5 fairly well correlated to like low sulfur vacuum gas oil? So like if there's strong refinery margins, should that not support this?
Yeah, exactly. Well, no, because then it's lead lag, right? So then if everyone starts buying up these things to produce as many products as they can, because the gasoline cracks are high, then you get waste products, right? Something has to give. Right. Not everything can rally.
Yeah.
So gas oil's starting to weaken, and then gas oil relationship with this is probably going to weaken as well. So
okay, so it's what's coming out of the refinery, not what's coming into the refinery.
Exactly. So basically what we're saying is the high value products that are being supported that were bullish, something's going to have to give way for that unless everything is in a supply glut, which I don't think we think is true. So basically this is the more likely one to give way than the others.
Yeah, I mean, it's a pretty exciting setup.
Yeah, to be sure.
And it's not very indicative. If you think of how high sulfur fuel is, it's not very indicative of like strong bunker demand, because if that 0.5 versus 3.5 like scrubber spread, usually at like $100, that, you know, incentivizes like VLSFO buying. And I think now it's like $60 or something. So
Really? Okay.
like, it doesn't look like the market is not trading like there's high bunker demand.
Right.
So like, I don't think that would just turn on a dime. And that's kind of where you might want some support from.
Yeah.
Because if you've got like, you know, all-time highs on high sulfur cracks, and that's not supportive of VLSFO, then that's not a very like good sign of like health in the kind of bunkering market.
Yeah. And again, the only thing I could say would be like, you know, the Middle East complex, if it's going to get tighter, that can keep up high sulfur fuel and maybe the medium stuff. But at the same time, like, as I say, like the traditional trade actually in low sulfur fuel, the original trade in 2019 leading into 2020 was when we had this switch, right? The IMO saying you have to have low sulfur fuel. Actually, the trade, because there was such a big premium, was actually to convert light sweets into fuel oil, because the premium was so good. You could just get rid of the condensate and whatever, and the LPG and all that, and then run that in your ship. So like, if anything, it's quite linked to that. But as you say, the fundamentals kind of with that, it's like it's still hard to get your head around. It's all over the place kind of thing. But anyway, I think we've said enough. I guess, Harry, for us, you know, what do we think is like a good standout trade from everything we've been talking about?
Well, I think, our bullish view on like flat price, time spreads, and what we've seen in Dated Brent, I think getting some exposure long Dated Brent.
So the more spot physical, because I think everything's lining up, like you're saying, right? You've got good refinery margins, gasoline rallying, good momentum on the Brent side. So if Dated Brent's more the spot, so we're getting more of like a physical view, Dated Brent minus Brent, the DFL, as we call it. We can show their contract up there on the screen. But ultimately, the setup for that, I agree massively, actually. Like, you've got a lot of support from the window, the momentum's there. It tends to outperform Brent spreads and flat price on a percentage return, I guess, type thing, when everything's strong. And the refinery margins being where they are. Yeah, I agree with you.
It's like pretty supportive, right?
Yeah. I think actually, Manny, on the Trading Corner, which is with James Anderson, another episode we do directly from the trading floor, I think they were bearish margins, right? They said sell margins, buy crude, but it's kind of the same thing you're saying, right? It's just like the margins are strong enough, just buy the crude part of it. So that makes sense. I like that. And we could always look at the setup there, but I guess, how would you put that trade on right now? We're looking for like probably a 5 to 10 day trade just to ride this momentum, right?
And then I suppose we can come back to it next week and see like how the week's played out. But
why I think it's a good trade is like you're not at the mercy as much of the Brent spreads. So if you're kind of late into this trade, basically if you buy it and the physical support's there and the momentum's there, it will start to perform. But then because it's an OTC contract, not that many players, they kind of don't want to see it lower, right? They can keep buying. So as the Brent spread's lower, they can still buy Dated Brent. So the diff, like Dated Brent minus Brent, can probably actually get stronger, if anything, if Brent spreads weaken. So I like that, because you've got the physical guys supporting the trade houses and the majors on your side there. So that, I think that's quite a solid, like risk averse way to be long in a way on crude. So that's a good one. All right, great. We'll leave it there then. I mean, thanks guys. That's our first stab at the Flux News podcast. The whole point of this is to get like really, really trader focused. We want to hear your feedback. We want to start a community here. We've got Onyx Markets that Harry's all over. That's everyone in the world can trade that. Institutions to retail. That's the whole point of it, the accessibility.
And they can trade these trade ideas that we've been talking about.
Right, and all the contracts.
All the contracts there,
Then you've got Martha on the research side. Obviously, she's working with the team to produce insights for free on Flux News, Flux.live, but also, of course, research subscription as well. But either way, guys, really keen to see you guys involved, your feedback. We're going to set up a WhatsApp community. We'll do everything we can to get engagement. Please ask your questions. There's an educational side to this, but we want to see you guys get stuck in, find this interesting and trade ultimately. But thanks for listening, and see you very soon.